mysterious crypto whales manipulating the market and causing huge Bitcoin crashes. But how evil are they really? And how can we deal with them? My name is Ainura, and today we're going to be talking about crypto whales. What are they? How do they manipulate the crypto market? What is whale alert? And how can we protect our assets from whale attacks? So, what are crypto whales? Or, to be more precise, who are they? Just as whales are the world's largest mammals, crypto whales are crypto market's most powerful investors. When it comes to Bitcoin, a whale is an account that holds 1,000 Bitcoins or more, which is about $30 million. Now, who are some of those whales? Well, it's not easy to identify the wallet owners as Bitcoin addresses provide some anonymity. However, there are four main categories of crypto whales. First is exchanges. A 2019 analysis found that an estimated 6.7% of Bitcoin was held in exchange wallets. 4 of the 6 largest Bitcoin wallets belong to Binance, Bitfinex, and OKExchange. Second is institutions, which include for-profit companies and funds representing investors. One of the biggest wallets belongs to Grayscale, which oversees $29 billion worth of Bitcoin, and it makes up over 3% of the current market cap. Grayscale is the largest Bitcoin fund in the world. Next is individuals. So several prominent investors bought Bitcoin early when its price was much lower than now. The founders of crypto exchange Gemini, Cameron and Tyler Winklevoss, invested $11 million in Bitcoin in 2013 at $141 per coin. That would make their assets, about 78,000 BTC, worth around $3.5 billion today. Other examples include venture capitalist Tim Draper with $1 billion and digital currency group founder Barry Silbert with $2 billion worth of Bitcoin. Finally, Satoshi Nakamoto, Bitcoin's pseudonymous creator, deserves his own category. He's estimated to have mined over 1 million Bitcoin in 2009. Although there's no wallet that big, of the first 1.8 million Bitcoin mined, 63% have never been used. So if Nakamoto is holding all these coins, he'd be worth around $40 billion today. So in total, around 13% of all Bitcoin, roughly $80 billion, sits in just over 100 individual accounts. And the top 40%, which is approximately $240 billion, is held by around 2,500 known accounts out of 100 million accounts in total. So it's easy to see how big wallet owners can manipulate the entire market. Now, how do whales manipulate cryptocurrency? Well, there are two main opposite ways in which whales can manipulate the market. We call them pump and dump schemes. For example, a whale starts investing into the coin they possess a huge amount of, driving its price up. Regular investors see this and follow the hype, buying the coin and driving its price further up. When the price is high enough, the whale dumps their overvalued coins on the people buying in because of FOMO. When the hype is over, small investors start selling their coins. And while some of them can still make some profit, most of them will sell at a loss. And the whale ends up with a huge profit. The opposite scheme is no less manipulative. As an example, let's say a whale owns 20,000 BTC at $50,000 each, so $1 billion in total. And suddenly the whale puts half of them for sale, driving the price down to $44,000. And it triggers stop losses and causes investors to panic sell. That keeps the selling pressure high, and it makes the price drop even further to $40,000. Then the whale uses their $500 million to buy more Bitcoin at a lower price. And such a huge purchase drives the price back up. Eventually, a whale ends up with 22,500 Bitcoin instead of 20,000. Of course, there are very few whales so big that they can manipulate the entire market this much. Usually, pump and dump schemes are coordinated between various whales and happen in a mere couple of hours. Now, you're probably wondering, what are the examples of whales influencing the market? Well, the steepest single-day pullback in Bitcoin history, by 50% overnight, happened in 2020 when whales started to sell high up. $1 billion in future contracts had been liquidated. And in 2021, whales bought 60,000 Bitcoin in one day. In their tweet, Stanimet stated, Bitcoin whale addresses holding between 100 to 10k BTC kicked off July with 60k BTC accumulation spike, the highest daily spike of 2021. These addresses hold 9.12 million coins combined after holding 100k less BTC just 6 weeks ago. And finally, remember the recent Terra Luna crash that we reviewed on our stablecoins video? Well, Terra USD was attacked by whales. In fact, Terra Luna pair dropped 20% after a whale dumped $285 million worth of UST. By the way, other big whales such as BlackRock and Citadel were also rumored to be involved in the scheme. And so this leads us to the big question. How do we track crypto whales?
Track, more track.
Blockchain has transparent nature, and so in theory, we're able to check wallet addresses to track crypto whales and predict how they're going to influence the market. If a wallet has more than 1,000 BTC, crypto enthusiasts will try to track its transactions. But the question is, what types of transactions are there? Exchange to wallet transactions. For security reasons, whales prefer to use cold wallets for their crypto assets. And so when they make a large withdrawal out of their exchange wallet into their cold wallet, that means they aren't planning to sell their coins anytime soon. Alternatively, an outflow of stablecoins can be a negative sign, implying that whales prefer to stay in cash and that they don't deem the current conditions good for investing. Wallets to exchange transactions. These transactions or exchange inflows can indicate the opposite, that the entity intends to trade them in the short to mid term. Large BTC deposits to exchange wallets may indicate a big sale in the near future, and in the case of stablecoins such as USDT, it may indicate a big purchase. And naturally, a sign that a whale is planning to sell coins would put a downward pressure on the market, and vice versa. So, as we can see, there is a number of ways we can track the whale's crypto wallets and predict their actions. But whales know that we're watching them, and so they can use transactions to trigger market reactions or do something unexpected. So basically, when you look at the whale looks at you. Now, what is whale alert? Well, whale trackers such as whale-alert.io are good indicators of the pump and dump schemes as they happen. Thanks to blockchain and public access to information, these trackers can show whales' public addresses, the number of funds they hold, and large transactions that happen. For example, if someone is doing an exchange to wallet move of 10,000 BTC, there's a good chance that selling pressure is incoming. And whale trackers can help you predict the pump and dump schemes and thus protect your assets. By the way, don't forget to subscribe to the channel, like and share this video as it allows us to make more interesting content for you. So, to sum up, crypto whales are not evil by nature, unless you think that any large capital is necessarily evil. But as large capital holders in any other economies, crypto whales, they play in their own league, and they enjoy the benefits that we, the small fish, can only dream of. However, using a constant market research and help of the whale trackers, we're able to monitor the behavior of whales and thus make savvy market decisions. What about you? Have you ever encountered a whale before? Tell us about your experience in the comment section below. And apart from that, thank you so much for watching, and I will see you in the next video. Goodbye.